Well, hello, good evening, and welcome to this live stream on the 7th of November 2023. Martin North here from Digital Finance Analytics. Great to have you on tonight, and lots to talk about as normal with Damien. We'll go over the markets, what's been going on, what might be going on, and what that means in terms of investing. As always, of course, you'll be able to ask questions, etc., etc. Just a couple of reminders before we get going. We're not providing specific financial or legal or indeed property advice, a general conversation only. We do moderate the chat, so feel free to throw those comments and questions in, but just to bear in mind that we do moderate. This is the 7th of November 23 if you're watching in replay. And if you'd like to get a question to the top of the queue, use @walk the world. That'll make sure that I see it, and that means that there's a good chance that I can get to it. And also, if you'd like to use Super Chat, I've enabled that so you can get your question right at the top of the list, or indeed make a contribution to what we do here. Always greatly appreciated. We do this not because we're trying to generate profit, but because we think there are some really, really important conversations to be had, particularly in the current environment we are. And therefore, those contributions really help to just cover some of the costs of what we do. So always greatly appreciated. Anyway, let me bring Damien in. Damien, hello. How are you going?
Very well, very well. How about yourself, Martin?
Yeah, pretty good. Been dealing with autumn, so this is the first autumn of the of the year, as it were, for me. And I've forgotten just how cold it gets and how the trees all sort of turn and drop their leaves. It's a long time ago since I last saw an autumn in the UK, but it's good. And a lot going on, a lot of questions going on in the markets as well as plenty to talk about.
There is a lot going on as usual, and I think we've I think as well because it's we've been doing this every Tuesday after the RBA, and we've had a 5-week version, so we've got one extra week to catch up on as well.
Yeah, that's right. Now, you mentioned the RBA, and we should probably start there, given the fact that the RBA did lift by 25. And it wasn't a total surprise, I think. They were sort of signalling, I think they would, with inflation stronger than expected. But for me, the interesting observation was that the minutes of the meetings were relatively similar to what we saw previously, but still a very strong intent that if inflation is stronger than expected, and we're going to be data dependent, of course, but the chances are rates could go higher. And in fact, some of the analysts post the announcement are talking about maybe another rate rise next month as well.
Yeah, look, I think they've been painted in a little bit into the corner by the government, I think, and it's interesting in that we had the governor come out a couple of weeks ago talking about this that yes, rents had risen a lot, but people's incomes had gone up, and so therefore actually people were better off, and so we didn't have to worry about it as much. And that was almost it was a bit of a weird, well, not a bit of a weird. To me, it was a very weird analysis. And it at the time it was like sort of the suggestion was actually is the RBA sort of are they not watching, or are they basically going to let this house price stuff keep going with the view that that had been done. And I guess the why I thought it was really weird analysis was because it basically the guts of it was that wages hadn't risen very much, but hours worked had risen, which effectively was sort of, I guess, Martin, that's sort of like saying to you, well, yeah, no, Martin, you used to pay $200 a week, and now you got to pay, $300 a week to rent your room. But actually, you managed to pick up a second job, and so now, and you've got another 6 or 7 hours a week, and so you're actually making more than that $100 because you managed to get a second job. So you're better off. Whereas I think most people would consider having to take a second job out to afford rent rises isn't an increase in their lifestyle. But so that was sort of the initial thought. But then, and I guess when I'm saying I'm talking about the government, about the RBA being painted into a corner, what I'm really saying there is that the inflation that we're seeing in Australia is the inflation that's very hard to control with interest rates. So one of the things we're seeing is a lot coming through in terms of the energy prices, and we've been banging the drum here for ages that a lot of that, most of that problems was that we decided, no, we're not going to put we're not going to put the burden back onto these exporters, the foreign companies that are bidding up the prices of Australian gas. We're actually going to force Australians to pay international prices, and that was basically a government decision. And really, there's not a lot raising interest rates can really do to bring down international gas prices. Having said that, they have come back a little bit, but on their own. But that wasn't it's through no fault of our energy policy. The oil price, had risen as well, and is still relatively high. Again, doesn't what we're doing with interest rates doesn't make a difference to that. And the big one, housing. We're bringing in a record number of people, and in a way, just in broad sense, if you look at the numbers, we were sort of bringing in. Back in the sort of early 2000s, the sort of like 100,000 to 150,000 people, and we basically doubled that to 225. And thought, wow, this is really, this is really up there. And just to show that, that wasn't enough, we've doubled it again. And so we're sort of running effectively 4 times higher than what we're usually doing. And so what that means for the RBA is they've got these energy and oil prices they're trying to keep control of, but they can't. Then they've got this huge housing impetus on it, which they really can't sort of do a lot about because that's all about the amount of immigration we've got. And so what that says to me is they're actually going to have to do a lot more if they want to bring down inflation. By effectively I guess easing housing demand in the face of this massive boom in terms of the number of people that the government seems to be sort of hell bent on bringing in, then you're going to need a recession. And I think that's the sort of bond market reaction that we saw following the rate rise, I think is the bond market coming to that same conclusion. Is that look, if they are going to raise rates, then that just means they're going to have to keep raising them until they actually cause a reasonable sized recession, because that's the only thing that would slow down housing demand. If you're going to run it, 500,000 plus people coming in every year.
Absolutely. Well, the migration question clearly is one that we've been kicking around for some long time, and 500,000 plus coming in, clearly putting a huge driver on, rental accommodation in the short term. I've updated some of my models actually, which I'll go through next week, which show the impact of migration on home prices as well, because they are actually supporting home prices more directly now. And so in my scenarios, I've now updated the more positive scenario for home prices to say, well, with such strong migration, some of those are now buying property, and that's putting significant pressure upward on upward pressure on prices in some areas. And the bottom line is this, that all of those issues that you raise with regard to the stickiness of inflation, none of it is going to be easily manipulated by just lifting interest rates.
Yeah, and arguably, in the short term, the housing gets made worse. You jack up interest rates, a few more house builders fall over because interest rates are high. Nobody wants to build a new property, and so we actually end up with less demand, less supply coming on. And so it's not a good scenario that the RBA finds themselves in.
And of course, it is broadly similar to other countries. So, higher for longer is a theme now that's coming through in the UK, it's coming through in the Eurozone, it's coming through in the US and in New Zealand too. So pretty much everyone who was expecting that rates would be turning down are now saying, no, they're probably going to be higher for longer. And, even the Federal Reserve last time around said, higher for longer. The question is, do we have to go again? But, these high rates, and of course that's translating directly into what's happening in the bond markets as well.
Yeah, well, and we live in this sort of financialized economy, as we call it, where the 20 years ago, what the stock market did or didn't do didn't seem to, actually maybe 20 years is a bad example. Actually, I might need to go 25 years before the tech boom. What the stock market was doing or wasn't doing really didn't have a huge effect in terms of the broader economy. Yes, there was some flow through, but given the amount of debt that we've put on over the last sort of 20, 25 years, and the amount of extra investments that are sort of are based on either housing or stock markets. What we're starting to see really is this effect between where stock markets go up, and that means then people go out and spend more money, and we get this wealth effect, and house prices go up, and people go out and spend more money, and then and so it's this sort of you're in this either this positive feedback loop, or you're in a negative feedback loop where the opposite starts to happen. And so I think we've described it several times in terms of saying, look, have central banks just turned into bubble managers? Are they here because they've got to keep the asset prices high? And if they don't keep the asset prices high, then demand will fall off, and all these negative effects will happen. And so, so that's we're left in the hands of the bubble makers, the bubble managers. Sorry,
the bubble managers. And this is interesting. So again, if you go back to the US, the Treasury there is issuing a lot more bonds. Maybe not quite as many as they originally signaled they would, but still are issuing a lot of bonds. And bond prices a couple of weeks ago were up above 5%. Look at the 10 or the 30. And there's a lot of debate about, well, what is forcing those bond prices higher? Is it all of that issuance in the US? Is it the term premium? Is it something else? Is it just massive uncertainty about what's going on? And I'm not sure I've ever got to a clear set of reasons as to why bonds moved as strongly as they did, nor indeed why they've come back a little bit. But it seems to me that the chances are rates in the bond market may not have peaked yet.
No, that's right. Look, I think there probably is a technical point of view in terms of saying sometimes there's parts where there's programmatic traders, and they tend to trade off similar types of signals. And once you sort of hit a few of their targets and you get the momentum behind it, they sort of everyone's models are saying, yes, this thing's going to hit 5% or close to it, so get out and buy it. Because everyone's models are saying the same thing, that sort of ends up, there's a bit of a weight of money, and then once it gets there, it's sort of the reverse happens. So I do think short term wise, there's the fluctuations from day to day. I'm not going to put down to a fundamental reason, I guess. I do think your longer term trends, I think there's the fundamental reason, and I think that idea that you've spoken about, and we just mentioned about saying if if we're looking particularly in Australia at events where what's happened so far it hasn't been enough, then we're going to have to put prices higher. So you're going to need interest rates higher to affect that. I think it's a different story in the US, and it's similar in some ways, but I think there's an overall there's a bigger delay this time than what we've seen in the past, and I think part of this is because so many people managed to managed to reset their mortgages at much lower rates. We saw quite a positive market for companies raising capital for a couple of years there post pandemic. So there was just all this money sloshing around, and so if you needed money, you could get money. The amount that companies could borrow and the length that they could borrow also extended. So we're for investment grade corporates at least, the sort of the average age of their loans is much higher now than what it typically is. And so in a way, I guess we've ended up with this scenario where both the consumers and corporates are less sensitive to the movements in interest rates because they managed to lock in rates. Now, that doesn't mean they're not sensitive to it, and it doesn't mean that as they finally start to roll off, that they're not going to start having problems. And we are starting to see some of that in the high yield sort of markets where it's much harder for people to roll over, and those tenors are coming in a lot, because what's happening is as the sort of somebody's coming up, medium small companies coming up, going, okay, you've got a $50 million bond which is just about to expire. Traditionally, what would happen is in the year before that, they'd then go and reissue a new one, and they'd get another $50 million, with a 5-year term or whatever it is, and that would sort of tide them over. Whereas what we're seeing is it's very hard for the companies to actually get that money up. where particularly these are the non-investment grade companies, they are having to put in more equity. So it's sort of turning up to going, okay, well, we're not going to give you the 50 million. You're going to raise 30 in equity, and we'll give you 20. And so what's happening is companies are delaying and hoping something will happen. And so they're not, you're not seeing those rollovers sort of go ahead. And so that's sort of, so that those sort of combined is why I'm looking at the US going, it's more of a delayed impact. And so that means, does that mean we need to raise interest rates and really punish the people who aren't locked in? And so I guess it's a similar question in Australia. Do you need to really punish the people? If we've got a third of people without a mortgage, a third of people renting, and a third with a mortgage, do we really need to punish that third with a mortgage in order to slow down the rest of the people?
Well, that's of course always the question, isn't it? Because these interest rate levers don't hit everybody similarly. And one of the questions, of course, in Australia is, well, why is it that the home prices are still quite bubbly? Why is it that some people still seem to be spending quite freely? Although if you look at the data, in fact, it's not buying more stuff, it's buying the same stuff at higher prices. That is actually the main reason why the retail numbers are actually doing reasonably well. So that isn't actually such a good story.
And well, I've got a lot I want to talk about that with food prices later, but we'll move on to that. Well, I should actually show this chart just at the bond ones. Now, this doesn't include today's one. This was from maybe a month or two ago. And it's just showing the policy rates in countries. These on the left in a number of sort of major countries. And so you can see Australia at the bottom of that. So now we'll top ourselves up another 25 basis points, but we're still below all these other markets.
Yeah.
Having said that, when you look at the change in mortgage rates, first of all, the change in mortgage rates you'll notice are much lower than the change in bond rates for all countries. But Australia's at the top of that band rather than at the bottom of that band.
And that's partly because we've got more variable rates than many other countries. So more people are directly exposed. And we, of course, have had that move from the fixed resets that are actually running quite fast as well.
Yes.
So,
and you can see that the US is that bottom one where they're at the top of one scale, but because they have 30-year mortgages, you can see the actual effect on outstanding mortgage rates has been 25 basis points.
Yeah, and it's interesting because I was listening to somebody the other day talking about the US property market, and they're saying one of the things they're seeing there is a lot of people now have got these very low rates locked in for 30 years, but what it is doing is freezing the market because they're not going to actually move, because if they move, then they actually have to reset their mortgage, and they're not going to do that at 6 or 7 or 8%. So
absolutely,
the long-term consequences are going to be interesting.
Yeah, and so ironically, in the US, what's happening is the effect has been that there's actually, I don't want to say it's a housing boom, house building boom, but it's certainly a much stronger house building market than you would have expected. And the reason why is exactly what you said there. Is that okay? So I've got a young family, say, and I'm in a 3-bedroom house, and I just have a child. It's like, oh, okay, I need to move up into that 4-bedroom house, and then I'm looking at it going, well, yeah, but I locked in at whatever 3% mortgage rates, and if I refinance, it's going to be 6%. I'm going to have to pay double the ongoing to do that. And then we're just going to have to we'll just have to buy a bunk bed, and we won't get the house. And so in the meantime, the people that absolutely have to are finding, well, the next person below who's gone from 0 kids to 1 or 2 kids is now going, okay, now I need a 3-bedroom house, but there's no 3-bedroom houses out there because they're not moving, and so then I'll have to go and build. I'll have to go build one, and so so the builders have been. In terms of proportion of the market is much higher than it's been. I feel like ever, but if it's not ever, it's pretty close to record highs in terms of proportion that new homes are making up of the total. The only thing is, it's not the same sort of housing boom that we saw, pre the financial crisis. We're not at that level of building.
No, and this is interesting because, of course, the other factor in the US that the debt burden is increasing quite significantly. And that is translating through also into consumers actually taking more consumer debt. And of course, they've now got to make their repayments on their student loans, which were frozen sometime earlier. So there's a bunch of consequences in the US for people over there. Now, in Australia, we have a much more direct exposure to the variable rates. And, even though some people are saying, well, maybe only half the rates have really percolated through yet. So even in Australia, it's trickling through. But certainly in the surveys that I see, more people are now saying, oh, hang on, this is a really big impost. And of course, for $1 million mortgage, you're looking at $2,500 to $3,000 more than you were 18 months ago per month. That's a big chunk of income.
Yes, exactly. And we haven't seen the same wage growth in Australia. So, as I said, I spoke a little bit before about, the RBA talking about that we've had sort of total income growth, I suppose, or household disposable income, I think was the measure they might have been using. That has grown, but that's grown because people are working more hours, not because we're being paid particularly more. Actually, we've got real wages going backwards. So, yes. We should touch on earnings as well, just while we're in that same...
No, let's do that, because this is now the really critical question, isn't it? If, in fact, future earnings are now going to come down for all the reasons we've been talking about, then the markets are probably overvalued. Whereas at the moment, some would argue that many of the markets are still priced for perfection of future earnings. Yeah,
well... If you asked me last week, I would have said they're not really priced to perfection. It was basically average. We got back to average prices. Now the market's up another 5% since then.
Yes.
So we got back to sort of average prices, but with really aggressive forecasts still. And that's the part I keep coming in to you and talking about this is what we're really seeing. Quarter by quarter for the last year or so, is that we're coming in with quite poor earnings, so sort of negative 5% ish. Except this quarter is slightly different, but it's been sort of quite poor earnings. But what's been happening is there's been quite bullish sort of forecast for the year out. Is like talking about 10-12% growth forecast next year. And every time we get a bad quarter, what happens is it just shifts out. It's going, it's still going to be great. It's just going to take one more quarter to get here. And then it's still going to be great. So we're always looking forward at this, the rainbow and everything's going to be great. But the actual earnings keep coming in negatively. Now, in the last quarter and quite possibly for next quarter, there's been a difference in that we've seen what we call the big seven in terms of the tech stocks. They've really done well. So I've got a chart up I'm just going to show, which is, so this is 2023 earnings, so still forecasts, out to the end of the year. And basically we're looking at about a 1% fall in terms of earnings. The thing is though, if you looked at the big seven, just the seven top stocks, which is your Microsoft, Apple, Google, Facebook, Nvidia, Tesla. I've forgotten one. There's another one stock in there somewhere. Amazon. Is that they're actually supplying all the growth. So they're all growing at sort of 15% plus type levels. And when you look at the actual earnings, so they actually add 2.6% to the entire market. This is the top 1,000 stocks globally I'm using, and then every other stock subtracts from earnings. So so if it wasn't for those we'd be back at sort of earnings down about 3 or 4% for the year. And then if you look at that another way, is this is sort of a similar type of chart where I'm starting at 100, and each of these little boxes on the chart show. The width of it shows how big this sector is, and the height of it shows how much it's contributing to growth. So that big seven is definitely contributing. The other big contribution is the financial sector. So that adds, those two together give you sort of 5% growth. Now, this is a sort of a mix of a whole bunch of different things, but a lot of it is that interest rates have risen, and so we've managed to the companies have managed to pass on the as banks would do, pass on the cost as quickly as possible and hold back on paying you more interest on your deposits. And insurance companies have managed to put through quite a lot of rises as well. But we haven't seen the bad debts come through. And so the financial side, again, is that, it's sort of a question of it's not an area where if we're headed into much higher interest rates and worried about higher insolvencies, that you sort of want to be relying on that sector. So that's how it looks for 2023, which is still, we've still got another quarter to report. The other ones, and actually and we haven't finished all the companies as well. Sorry, that's we'll still see more companies reporting. But then if you flip to 2024, this is where it's all the sunshine and roses. So every single sector is headed up. So the big, and it's not all coming from the big seven. So the big seven's only going to add about 2% to the growth. So, and just to, I guess, reiterate, the companies themselves are growing at sort of 10 or 15%, or maybe more like 10%, but then they make up 20% of the market. So they sort of add 2% to the overall. But yeah, every sector is forecast to be in the green all the way up. So I'm positive that's not going to happen. And the question is knowing which of the sectors, are going to be the ones that do suffer and which ones don't. That's going to be the trick. But it's a very aggressive forecast for where we are in the cycle.
Yeah, very interesting. And so there's two observations. One is, have analysts simply just reverted to norm? I mean, do they always start, with optimism? Well, it's going to be last year plus a bit. Right, and just apply that across the market, right? Which is what seems to happen.
Not even that. It's about 10%.
Right.
It starts with it'll be about 10%, and that's where almost every year when you're a little way out, it starts at 10%, and then it starts to break one way or the other as you get closer.
Yeah.
Now the interesting thing for this one is that it hasn't really changed. Like it's usually by now we'd actually start to see it starting to break down or break up. Like there's either, yes, we're in a boom or actually, no, things are looking pretty tight. But I think what I'm really seeing in terms of company commentary is a lot of uncertainty. There's, the best you can hope for is people saying, things we're hoping things will get better. We're not quite sure what's going on. Hopefully things will be back to normal next year. But And most of these companies are coming in saying, on average, they're reporting earnings down sort of 5%. And they're sort of going, yep, last quarter was down 5%. The quarter before was down 5%. This quarter's down 5%. But actually, hopefully we're reaching the end of it. Maybe next quarter will be flat, and then we'll start to grow. And, by the end of next year, we'll be growing at 10% again. Is sort of, the rough guide. But a lot of uncertainty in terms of that. And there's not a sort of, I can't find a common thread behind this. Like I was, I've read through a lot of company announcements and a lot of the earnings and trying to get to the bottom of, because for me, this is the key part. I'm trying to work out, have I got this wrong or am I crazy that, this is this is the forecast that everyone has there. And so I spent a lot of time reading it and I can't find. So sometimes you do see it. You see that people start coming in. They're like, actually, demand's way stronger than we thought, or costs are way down, or the oil price has fallen, or our rents are falling, or whatever it is. And there's some sort of theme. You can just sort of read company after company after company saying the same thing. But for my part, I really can't get a common thread behind this. Can see it within the big seven, but outside those stocks, and most of that sort of is AI driven, but outside those stocks, it's hard to tell.
And just on the Australian context, so we have some results now for Australian companies. Now, the Westpac reported very strong profits, as you'd expect, I guess, with the interest rate differential moving up. Right? Yeah,
and that's exactly what I'm talking about. In that, what we're seeing that this year the financials are up because
But then the question is, how does that play out with higher costs of funds ahead, with probably higher bad debts? And interestingly, I did notice that in the US and in Australia, the provisions weren't as strong as I expected them to be. So at the moment, they seem to be, backing the idea that there's nothing to see here.
That's right, and I think there's certainly increasing commentary that we're seeing around is that look, maybe everything's going to be fine, and consumers have handled it so far, and so therefore, maybe we're all wrong to consider that these increases were going to make a difference. And so, I guess there's two parts to that. Then, you have to say, yes, maybe there is the case that the consumers are just way stronger. The second one is consumers did build up a massive amount of savings during the financial crisis, and that's largely run down. And so that's one part about when that reaches the bottom, and certainly for the lower incomes, it appears to have already reached there. Does that then start to bite? And then the other part is this idea that because people locked in for a while, that it's just a delayed effect, and so so I think that's where we're headed.
Just one quick question. Jake threw this question in, which is quite interesting. Where do mining companies sit in the economy? Talking about Australia here, strong with resources prices. So in other words, is there a bit of a buttress that we have that maybe some other economies don't have because of our resource sector? Or how exposed are we, I suppose, is the way to turn the question around.
Look, it's been Australia's always got that interesting extra overlay in that Australia tends to be like a supercharged version of what's happening in the world economy. And this is I'm talking if you're an investor outside Australia. So if I'm an investor outside Australia and the world economy is booming, I'll buy Australian stocks with a view that the Aussie dollar is going to go up because commodity prices will be strong, and commodity prices will go up because when the world booms, that's commodities are this they have a very static supply, and so you don't need demand to be much above the supply to get this big price increase, and same on the other side. So I'm investing in Australia, and I get the currency goes up, and the value of the stocks goes up, or vice versa. So you get like double the effect. If we're an investor sitting in Australia and looking out, it actually offsets. So when the Australian economy is going the world economy is going really well, then the Australian economy is probably going pretty well as well. The Aussie dollar is going up, and that actually offsets the effect of rising prices elsewhere. So global markets go up by 20%, the Aussie dollar goes up by 5%. The net effect is you've actually only gone up 15%, and vice versa on the downside. Which is sort of where we look at it at the moment is why we don't mind having a bigger exposure to international, because the falling Aussie dollar has been cushioning that. So so that's one part. What are the actual transmission mechanisms for the Australian economy to get these higher prices? So on energy, actually on oil, on gas in particular, there's very few transmission mechanisms because we just don't charge the companies anywhere near the taxes that you see anywhere else. So actually the global gas price doubles and triples, and actually the average Australian consumer is probably worse off because we're paying more in gas. Whereas most other places like big exporters like a Qatar or somewhere like the US, gas prices up is a big positive because the government gets all these extra tax revenue. The coal price does flow pretty quickly through, especially into state budgets. We really do get the effect of that. And then for the federal budgets, they get the extra profits from so that is an effect not for average consumers, but for governments, it's quite big, and it's sort of similar in iron ore. The government sort of gets the benefits from there. If you're expecting though a weak world economy, then that's usually not good for Australian stocks and the Australian resources markets. So it's extra bad usually on the way down. Having said that, what's been interesting and surprising to me is how much the iron ore price has held up. So the narrative really has been there was this narrative going around 6 months ago or 9 months ago, which was you want to be invested in the industrial metals, so coppers and things like that, because China's still exporting lots, and there's this green demand, and so there's this great big demand for copper and through the goods, but there's this housing crash going on in China, and so the most affected is going to be iron ore, because that's where 30% of the global iron ore goes into Chinese housing. We roll on 9 months, and most of the fundamentals that, as people spoke about, it has happened, but actually we've seen the opposite happen, where the industrial metals have all fallen, but iron ore has actually managed to hold up. And so it is a little bit of a mystery to me. I do think there's probably an element of just trying to build as much as they can, and we've spoken about the Chinese developers really being effectively utilities now. They've just got too much debt to actually be real companies themselves. In any other country, in any other time, these things would already be bankrupt, and you'd be picking over the pieces. But China's, because they've pre-sold so many houses, our view is that they've basically just said, well, we're going to prop these things up until they've built at least most of what the people have already paid for, because otherwise, there's going to be pretty dramatic effects on the broader Chinese economy. And so maybe that's the case. Maybe it's a bit of stockpiling. There's certainly the other thing is there's been this dramatic drop in terms of the amount of recycled steel that's going through the Chinese economy. But the iron ore price is a little bit mysterious in terms of why it's held up so much.
Yeah, and talking about mysterious, I suppose the other thing we should talk about is the oil price, right? Because if you go back,
Yes.
3 or 4 weeks ago, particularly when the Middle East thing blew up, prices went up quite strongly, but they're back down to where they were again. Now it's like, well, nothing much happened really with regard to oil. So what's going on?
Well, I wanted to throw a few things into this. So I think that my take on this, and I certainly won't get anywhere involved. I don't want to touch any of the who's right and who's wrong on any of this stuff, because I think there's a lot of wrongs on both sides.
Yeah.
But the reality is, it's a very regional conflict. It doesn't affect major economies. It looked as if China, it looked more so than in the past, this looks like a proxy war. So Israel was looking to do a deal with Saudi Arabia and the US, where the Saudis would get more protection from the US and more weapons from the US. The Saudis would then normalize relations with Israel. And it looks very much for me that Iran's decided that isn't what they wanted, and can completely understand why they would decide that, because then they're sort of encircled. And so they've got their proxies to launch this on Israel, so that the Arab man in the street would no longer countenance, normalizing relations with Israel and this type of thing. So in a way, Iran's got what it was looking for. And so from a sort of a purely illogical point of view, saying, well, they've got what they wanted for. Do they want to extend this into a further regional conflict? And you'd probably say the answer is no, knowing though that sometimes these things do get out of control, and maybe it's hubris, or maybe, that they decide that worked so well that we're going to try and do something else, and that backfires. But the idea of, will it actually expand into a regional conflict is really the only thing that we think would make a significant difference to the oil price. The other thing I wanted to bring up as well is a chart, which is a scatter plot of basically on the y-axis, so up and down is what the 5 year forward inflation expectations are, and I'll explain that in a minute. And then on the x-axis is the dollars per barrel, and so the 5 year forward is what the market's pricing in inflation from 5 years out to 10 years out. So sort of getting away from the short term machinations of up and down, and it's sort of saying, well, what are investment markets pricing in over that longer term time frame? And you can see there's a pretty linear relationship between the two. As oil price is low, then people are expecting low inflation, and the higher, so at $40 oil, people are expecting inflation of somewhere between 1.5% and 2%. So relatively low inflation. But then as the oil price rises, people start to factor in higher and higher oil prices. The interesting part, though, happens once you get past $100, where that relationship actually starts to go the other way. So markets actually start to price in lower inflation once you hit over that. And the idea there is it's demand destruction. So there's two ways you can look at the oil prices. One is that we end up in this upward spiral where oil prices go up, and therefore workers go, well, I need to spend more on oil, therefore I need a bigger pay rise. And so then they get a bigger pay rise, and then that goes back into inflation, and then that goes back to what, we get more inflation, and then workers want, and you end up this spiral upwards. The other way, the way of looking at it is saying, actually, people have this sort of fixed money to spend, and if I've got $300 a week of spare spending money that I'm going to spend on restaurants and entertainment and food and things like that, if all of a sudden I have to spend $50 more, fill out my tank, then now I've only got $250 left, and so therefore it actually destroys demand. And I guess the market pricing certainly says, well, beyond $100 of oil, that's where that really starts to destroy demand. And so we're sort of drifting back down. And so that's sort of one more reason, I guess, why I think there's, well, at a certain point, they're starting to factor in that demand destruction once you get too high. And I think if you do go into this, into a broader regional conflict and we see oil prices spike, then I do think there is a certain element of that will be detracting from budgets rather than reigniting inflation, is my take.
Yeah, and it's interesting because some of the commentators were talking specifically about the lack of demand from China for oil as being one of the reasons why it was that prices were actually coming down a little more than perhaps people expected earlier on. So I don't know. It's a really complex story, but clearly there are pivot points. If it gets too high, then, as you say, demand destruction. If it gets too low, that has a bit of a different effect.
Yes. Now, while we're on this one, I wanted to throw up another chart, which is saying a similar type of thing, saying, okay, will people switch to electric vehicles if prices get too high? And I think the broad answer is yes, people will, but it doesn't really make economic sense yet. So we'll still need to see battery prices come down. So battery prices have been falling consistently over the last sort of couple of decades, but particularly in the last 10 years, we've really seen a dramatic fall in the price of batteries. They do still need to fall further for the average US consumer. So I've got here a chart which has got the oil price on the x-axis, and then on the y-axis is how many years would it take you to pay back your battery. And this varies by country because electricity prices are different in different countries. In the US, you've got both cheap electricity and cheap oil. In Europe, you've got expensive both. In Australia, sort of sits somewhere in between. And so most of it all comes down to range anxiety, though. So in the US, at $100 of oil, and if you were willing to take a 300-kilometer battery, then you got about a 4-year payback, or sub 4 years, which I think's starting to get more reasonable. If you do want to get, if you're sort of along the lines of no, I actually need sort of an 800-kilometer, sort of 500-mile sort of range that you get in some of the sort of the more top of the line Teslas, for example, is that you've got like 8 or 9 years of payback on that. And I think if you said to people, buy this car with this battery and you get your money back in 9 years, I don't think that's an economic argument that flies with most people. I think they'd want sort of 2 or 3 years, I think, is probably the limit to where it is. And that it also shows you that if even at if you got to $200 oil, that 800-kilometer battery is still going to be like a 4 or 5 year payback period on that. So it's sort of a range anxiety thing. If you jump to I didn't put the chart on. Sorry, I forgot to put in the chart of the commercial, because if you jump to commercial, because they drive so many more kilometers each year, this is much lower. So now it's like at $100 oil, you're like it's basically pays itself back within a year if you're if you can get away with a small battery. So, for example, if you're driving 100 kilometers a day, you can probably get away with a 200 kilometer battery, and you just gets charged every night, and it's the same route, and so you don't need to worry. You don't have to have this range anxiety. You can just sort of buy a battery that's big enough, and the payback on those is basically you're there now on commercial vehicles. But it's the passenger vehicles where people have got much bigger range anxiety and much more. They drive a lot less, and so all that sort of feeds into the numbers just don't really add up at the moment for people to switch. Europe looks way worse as well. So because they drive less and they've got higher oil prices or much higher oil prices but higher electricity prices as well, that the economics, you even on a 100-kilometer battery, which is sort of this, effectively the really small ones you can see there. You're still talking over sort of 4 years in Europe. So, the Europe is about the subsidies really, which is sort of driving the EV take up or sort of a demand for, carbon neutrality. There isn't an economic argument at the moment until you see battery prices probably about halve again from where they are.
Right. And that's not going to happen immediately, is it?
No, you're probably 5 years away at least. The other one is Australia's somewhere in between those. So it doesn't look particularly good for Australia. If you're filling it up from your from your batteries, then these equations look a lot better, but not that much better. And Australians don't drive as far as what Americans do. So basically at the moment, if you're an Australian, you're driving 40,000 K a year, then it's absolutely worth it. If you're like most people and driving 10 to 15, it's very hard to make the numbers add up on batteries at these levels. Where could the other big one is the driverless cars. That's a theme that we've spoken about a little bit. There's basically been some pretty big jumps forward in terms of the technology. So both Waymo and GM were given they've been given a number of different licenses within the US to really start expanding those, but GM's actually run into a bunch of problems and it's had to pull back and pause that. So but Waymo, which is the Google offshoot, seems to be doing pretty well. And so if you got a broad rollout of driverless cars, then that would absolutely make sense to be much more electric, because they are going to be doing 100 kilometers a day or more, and so that they absolutely make sense. And the idea for you lose a lot of the range anxiety stuff because so you can put much smaller batteries in them, because they'll if I'm going from one place, if I'm going into the city, I don't actually care whether whether it's full or empty, as long as it gets me there. And if it then needs to go drive off and charge itself for an hour or two, that's the operator's problem, not my problem. So that could make a big difference. But again, that's at least 5 years away, you'd think, from a really major rollout. It's probably, I do think they're going to ramp up over the next 2 or 3 years, but it's not going to be enough to put a dent in oil demand for some time still.
No, it's interesting because in the UK they've been pushing this a bit harder. In fact, they've now extended the duration over which people will still be able to buy petrol rather than just electric. They kicked it a long way out. But the main problem is charging stations and range, even in the UK, which is a much smaller island relative to Australia. And many people just cannot find the charging points. Or indeed, even the rapid charging is still relatively slow. So the whole question of the evolution of the electric vehicle for personal use is definitely slower than expected. But what's happening is that it is actually those delivery routes, those relatively small areas in the commercial sector, where it's actually taking off quite fast for the same reasons that you've articulated.
And predictability, because it all comes down to, when you think about this and you go, if I need an 800 kilometer range on my battery, now realistically, most people are doing, if you're doing 10,000 kilometers a year, you're doing whatever that is, 200 kilometers a week, and so that's an 800 kilometer battery is going to last you 4 weeks between fill-ups. Realistically, you don't need that. You could trickle charge it, easily. You could probably, if you're doing 200 kilometers a week, you could get away with a battery that's probably 100 kilometers. But there's a range anxiety, and if I do want to do a longer trip, I don't want to have to be sitting, stopping every hour to recharge and all that type of stuff. Yeah. But if you're on a delivery vehicle and you know where you're going and you're only driving 50 kilometers a day, then 100 kilometer battery is fine. But I can do twice as much and still know where I'm going. And that just means that a battery that'll go 100 kilometers is an eighth of the price of a battery that we do that would do, or maybe it's not an eighth of the price, but it's probably a sixth of the price of a battery that would do 800 kilometers. And so, so that's what it all boils down to. And so while we're on there, I thought I might touch base quickly on some of the energy costs as well, just while we're talking sort of big pictures, because I think for me, these are definitely trends which I think are going to occur. We will go to electric vehicles, and they will be cheaper, but we'll go there when they're cheaper than petrol vehicles, and they're coming down in cost every year. And the batteries are getting better and faster charging. The solid state batteries that are coming out in a couple of years. There's all these great things, but they're not here now. And I don't think these trends will occur until we genuinely see. And so the other one I wanted to talk about, we've spoken a little bit about, we've heard sort of the Liberal Party and a few others come out talking about nuclear power. And I just want to sort of touch base on some of the energy costs as well, because we are at a much closer transition point of that. And I just wanted to highlight one thing, which is, there's a lot of talking about transmission costs and about how much extra transmission we're going to need to build to cater for all this renewable energy. And that is true to a certain extent. But I've got a chart I just wanted to show up, which is a 2021. So before the prices sort of took off, this is from the ACCC just saying, your average residential bill was $1,400 a year. Where does that come from? So 32% of it was actually generating the energy. And the rest of it, the other 68%, is everything else involved. So 45% of the biggest cost was actually the network charges and the distribution. And so they're the biggest players in our industry. And I just want to make sure that, when you see this stuff written up, often in various news organizations, I feel as if it's come from these distribution people who are saying, whether you're spending money on us, we want you to keep spending money on us, and so we're going to try and design a network where we have to build more transmission, and so that we're the biggest cost. And that's where the idea of that the solar power, which is very, very cheap, but obviously intermittent, and you need batteries for it. If you're placing batteries pretty close to where, so if you're close to where it's being used, then you can cut out all that network charge. Like, you don't need those. So if you're, for example, if you've got lots of people with panels on their roof and it's all feeding into, say, a community battery of some sort, then the battery's going to cost you something, and it's going to be, and that will actually add to the cost. But your 45% of your cost is that network distribution charges of having to ship the energy long distances. And Australia's got one of the longest transmission networks in the world that we often talk about and say, about how our transmission network runs all the way from the top of Queensland, into South Australia. And the question comes to be, say, well, why do we have the world's largest? And have we got the tail wagging the dog again? So we've outsourced, not outsourced, we've privatized all these things. We've got all these private companies that were gold plating our networks, and we're always sitting there trying to work out how do we stop these electricity companies from overcharging ourselves. And I'm just worried the debate's being captured by these people who are like, we've got to build all this extra transmission because that's what I do. And so when I build more transmission for you, then I can charge you more. And so, anyway, I just there's that. And then so I thought I'd throw up the fees, the costs again, because we have seen some prices come down. So utility solar, and so I'm doing all this, and I just want to, I guess, premise this by saying these are all sort of rough figures. So in sunny areas, it's cheaper. In less sunny areas, it's more expensive. In areas that are closer to, you don't have to distribute it as far. The costs will be less again, and more when you have to build this in really remote places and all that. But as a broad sense, utility solar and onshore wind are sort of we're talking about US dollars, they're about 3 cents per kilowatt hour. So they're really, really cheap, but intermittent. So you need to start adding batteries. Then if you look at natural gas, it's costing about 2 cents just to build your plant, and then your fuel costs if you're at $3 per MMBTU, which is the US cost, add you another 2 cents. So you're basically you're roughly the same cost at that price. So let's say you're sitting in the US, and particularly in some of the northern states where the solar is not going to be as good, and the intermittency. So actually, natural gas at $3 is still the best one out there when you're in those types of areas. If you're more like Australia, though, where you're talking about say $10 for the price, you can see that sort of comes up much further down. And the cost of that the fuel cost is that 7 cents of fuel cost is actually really what's adding most of that to it. So at higher gas prices now, and then I've got right at the bottom, I've got the gas prices that we sort of hit during the during that sort of Russian invasion, and gas prices really took off. At those prices, it's worth the fuel cost alone is higher than the solar plus battery cost. And so that's where, I guess that's where I just wanted to highlight that where those costs are. If you start needing to add sort of batteries to these things, then your solar costs are more than doubling. And what I'm saying, a partial battery is sort of like, okay, I just want to shift a fair chunk of the power out of the middle of the day and into the sort of early evening when most of it gets used. And then there's sort of I've called it full battery. It's probably not really a full battery, but it's a battery that would last most of the 24-hour cycle, as long as you didn't sort of run into a whole bunch of cloudy days and things like that. But so that sort of gives you a rough idea of the costs. And nuclear is above that. Now there is an argument for nuclear, which I'm perfectly happy to accept a nuclear argument in that. You're doing it for grid stability, and you actually want something that's there and stable and just pumping it out all the time. And it's different to other things so that you're not, your fuel costs are very low. And so even if even if the uranium price tripled and quadrupled, it actually hardly makes a difference to the end cost of this. So if that's your argument, then I'm certainly, I can live with that argument. There's not a cost argument. And the argument that's sort of being that's going around at the moment about the small modular reactors and how they'll be so much better. So there's a company I follow that I follow one of the companies that's the main producer of these, and their costs keep getting, like, the cost they said they were going to produce these things for 5 years ago is half of what they're saying it's going to cost them to produce them now, and keeps going up. And we still haven't got, in a developed economy, one of these things up and running and proving. So it's still a pipe dream. So I guess what I'm saying is, look, prove it, prove that you can do it. And the issue for a lot of them is a lot of the nuclear power is much cheaper in places like Vietnam or China. And the question is, well, why is it cheaper in third world countries to build these? And the answer, by and large, is a safety aspect. So if we're willing to because there is significant red tape that needs to go in. Like, they spend a lot of their time building things 3 or 4 times because the first time wasn't inch perfect, and they have to do it again and again and again. And that's the type of stuff that often doesn't happen in some of the developing economies. They'll just do it once and say, oh, well, yeah, if it's out a bit, that's fine. We'll live with that. And so if we're willing to compromise on the safety aspect, you could absolutely get the costs down. But I don't think that's I don't think that's an argument that's going to fly with the public. So anyway, just some rough thoughts on people if they're looking at energy costs and what's reasonable and what's not.
Yeah, and just a couple of observations. The first is, of course, these these issues become more politicized rather than actually economic. It seems to me, you take an ideological position and hold it. The other is, of course, that.
Well, actually, before you go on from that one,
yeah.
Let's say I was a very rich Australian who had a lot of coal mines.
Yes.
I would be very keen for people to explore the concept and say, no, don't build more solar stuff. Let's talk about building a nuclear thing, because even if the debate we've got over the line in the debate in the next year or two, and everyone said yes, nuclear is the way to go, we've got to build this. These things take 5 or 10 years to build. So if I can now keep pumping coal out of my coal mines for the next 5 or 10 years, I've just gained myself some extra life on it. So so the politics is absolutely there. And again, if there was an argument that said it's stability, we want to stabilize our grid, we want to have a different diversified source and all that type of stuff like that, I'm completely on board with it. And other countries, which do have significant nuclear, we have a tilt, for people who want to, invest. We have a screen to screen out nuclear power. We have a tilt for people who like nuclear power to add it in. We realize there are people who have strong feelings in either direction, and they can do that. But I think there's the economic argument. I want to tap down on. And sorry to interrupt. So that was the political side.
No. You exactly developed the point I wanted to make, that actually there's a whole bunch of, power and political stuff that actually is shaping a lot of the debate, but it's not actually necessarily a good, pure, honest debate. It's very much politicized. The other one, though, is, of course, Chalmers recently made the point that with the inflationary pressures much stronger, they're going to have to look harder at some of the infrastructure spending that they were planning to spend. And a lot of that infrastructure, by the way, is at the state level. So again, we've got this other issue now bubbling along about how much infrastructure should we be building and what type of infrastructure should it be. Again, it's a political argument.
Yeah, but I don't know, Martin. In your experience, don't we build infrastructure so we can bring inflation down? Isn't that the point?
Well, you wonder.
Isn't that what we're using? Infrastructure. We build infrastructure. It helps improve our productivity. We get to bring prices down, and so therefore inflation's lower. But we're saying no, inflation's too high. We can't afford to build this stuff.
I know. Which is a wacky. I mean, I could not make head and a tail of the argument, right? Other than, again, it's another fight they want to have, right? And unfortunately, and to my mind, it is really missing the point, particularly in the current environment with all the complexities that we've got. And it's all about, you touched on productivity. Just to underscore again, our productivity in Australia, and by the way in the UK too, is going backwards. It's been going backwards for years and years and years and years. We are less efficient. We're actually creating less per capita than we were. So the whole debate about productivity improvements seems to have been, again, swept away.
Absolutely. Actually, can I I forgot I had one other chart for people who are playing along at home and talking about rooftop solar. The interesting thing with rooftop solar for me is you're not competing with all these other technologies, because you don't care whether it's cheaper to produce nuclear power or coal power or whatever like that. You just care about what are you getting charged versus what are your costs. And batteries for me are still not there in terms of because the prices are different in different countries. So if you look at, say, China or India, the electricity is often subsidized, and so rooftop solar doesn't really add up in those ones. Some of the utility solar can, but for the average individual, it doesn't add up because you've got subsidized electricity prices. Even in the US, where electricity prices are quite low, rooftop solar makes sense in the sunnier ones, but not in the more winter ones. It makes sense from an economic point of view. It does make sense from a reducing carbon and all that type of stuff like that, and stabilizing bills, and there's other reasons people do these, but purely economic sense, which is where it really needs to take off. But adding the batteries is still really, even if you're just doing a partial battery just to sort of offset some of the stuff in the day to get rid of that sort of nighttime main use, it's still, it's not really economic in most places. There will be some cases where you use more energy or all these things like that, or whatever. But we still need to see these battery prices come down, and they are coming down. So we had a big blip from the lithium price, where energy prices, the battery prices fell and then popped up for a little bit for a year, which is the first time that's happened in a long time. But it looks like now we're reverting back to that trend and going lower again. So, yeah.
Yeah, very good. So I guess if we take the conversation forward from this point, with all the things that are going on, where are the sections in the investment universe that you think are worth focusing in on? And you clearly this is an area. Are there others?
Yes, yeah. Actually, I was going to do the weight loss guys. Before I do the weight loss ones. Actually, I might jump onto the food one, because that's another interesting area. We're sort of digging into this in terms of, I'm trying to work out what the hell is going on with with food prices. We've put this chart up a few times. So this is the UN's food price index, and they're pretty diligent. Like, I don't doubt that they're genuine in terms of what they're pulling out here. It's a little bit of a weird graph, but basically what it's showing on the left-hand graph is each line is a year. So I'm going to focus on the orange line, which is a 2022, where we saw food prices take off as the Ukraine war started, and then pretty much from there fade the whole year. And now into 2023, which is the red line, we've just seen food prices keep on coming down, and now they're sort of below 2021 prices, and we're headed back towards 2020 prices. And then you look at each individual one, and cereals, and this is over sort of a year and a half, which is the graph on the right. Cereals, which is the yellow lines, down, 30%. Vegetable oils are down, like everything's down except sugar, basically. And sugar's a pretty small ingredient overall and not that expensive anyway, so it's not really making a difference. Now, that is not what I think most people are feeling at the grocery store. I'm pretty sure most people are saying, really, cereal prices are down, from 150 down to 100, down to the 30% over that 18-month period. That's certainly not the cereal that we're buying on the shelf at Woolies. And so, when you look through some of the inflation numbers, we're certainly still seeing it there as well. And so, one of the things I keep track of is the cost of farming. So farmers, you get some interesting breakdowns because I'm going to use this is a Canadian one I've got up here, which is basically saying what they look at all the different types of crops, and they provide this analysis to farmers. It's like a government agency, so it tries to say to people, okay, if you plant wheat, here's what your costs are going to be. If you plant barley, here's what your costs are going to be. If you plant soy, here's what your costs are going to be, so that people can sort of calculate what they want to, which crop is going to be the best and most efficient for them. And if we look through and I'm using the hard red spring wheat, which is the biggest, their biggest crop. And if you look through it, fertilizer costs are up well over 100%. They've been falling back in 2023, but you've gone from $70. I think this is an acre. Yeah, I'm pretty sure it's per acre. It's gone from $70 to $184, and now it's back to $164. So yes, it's falling, but it's still way above what it used to be. Your seed costs are up. Over a 5-year period are up 40%. Pesticides are up. That's probably a bit more reasonable. It's up only 17% over 5 years. So, that's sort of a little bit more than 3% per annum. So that's not that bad. Fuel costs are up. Machinery, you get to go through line after line after line. And sort of for some of these doesn't make a lot of sense. But the other thing we do see, really starting to flow through now is some of the land costs and the machinery costs, in that higher interest rates are really starting to will make a difference. So, if you have to factor in the cost of your land and interest rates are 3 or 4%, then your land costs are much lower than if your interest rates are sort of 8%. And so So I guess where I was coming back to is saying, well, is the farmer, is this the farmer's fault? So, and it looks like, well, actually, the farmer looks like they're really being squeezed in this. So they're not really making that much money out of it. You start looking at some of these other factors. So we spoke about the fertilizer costs, going from $70 to $180 and back to $164. Well, fertilizer prices themselves they're pretty much done the round trip. So I've got nitrogen up on screen. That was it's 400-ish per ton at the moment. It was maybe it was 300 pre this whole thing, but it's certainly come well down from the $1,000 it traded at its peak. Potash is sort of done a similar type of round trip. Phosphate, which is that's your three main fertilizers, that's done the round trip. So it doesn't really make sense as to why the prices haven't fallen as far as what they have. And so the question then comes back to, are we talking about greedflation? So, is this something we can, so as an investor, is this somewhere where we should look? So you're looking at, this aging population. We're looking at growing population, another 2 billion people are going to be added. We're going to need all this extra food. You've got harvest losses from climate change. You've got arable land being lost from erosion and things like that. These are things where we're looking at, should we be putting more of these food companies into your portfolio? And I think there's partly an argument to do it, but I think it's probably a little bit too early for these yet. So I've just got a grab bag. So if you wanted to do this in one of our, you had a passive portfolio at Nucleus and you said, oh, actually I want an agribusiness tilt. I do think this is going to be a 10, 20 year theme. I want to have a bunch of agribusiness companies in my portfolio. Give me the top 8. And what we'd do is we'd throw in these ones you see here. So a bunch of farm machinery ones, some crop ones, fertilizers. You get a few pharmaceuticals, Tyson Foods, which sort of packaged foods and meats, and you look through them and they're relatively cheap. Some of these you can pick up on some of them are on single-digit PEs. So the PE of the market is about 18 times. And so these are all trading well below that. And sort of something like a C&H Industrial, which does farm machinery, is trading on 7 times or 6 times. And so is Bayer. Both of those got their own problems, though. I do want to say. So not all these are fully justified. And it does look as if when you dig through them, they're still really benefiting from those high prices. And the question is now, so most of these companies do seem to have done quite well out of the inflation and managed to push on more than what they managed to get. So the question is, are we going to see the other side of that, or are they going to hold on to them? That's the part I'm not quite sure about. I think I do think this is an interesting sector to jump into, but as I look through the lag effect, and I can see the sort of front end of that curve where things like the fertilizer prices have all fallen off and are back to almost normal, but the prices that are being charged to the farmers through these the people that are packaging them up, that hasn't fallen back yet, and they're still really getting the benefit from that. And so if they have to start pushing through those price rises, the price falls, and you start to see some more competition, then you're going to see earnings fall off in these. And so interesting sector. Certainly one I'd be putting on your watch list, but for me, I'm not quite ready to buy that one yet.
And presumably, if you think of the pricing power of particularly the big retailers, they've consistently pressurized the production chain to maintain their margins, right? In fact, the most recent margin reports that I read showed that the big players are actually extending the margins, not contracting them. So maybe that's where the value piece of the puzzle is, because end users are paying a lot more than they were, as you saw from the ABS data.
Yeah, and the just the fact we've seen so much inflation has normalized price rises. I think that's one thing you very much hearing from companies is that 5 years ago you tried to put through a 10% price rise and all your customers scream blue murder, and they'd all be threatening to leave and getting quotes from other people and, you know, all this type of stuff like that.
Yeah.
Whereas nowadays it's like, well, prices are high everywhere, you know, in under their breath, it's like, well, not for us though. We haven't, but everyone else is putting up prices by 10%. So have we. And because people are used to it, they don't scream blue murder and they don't, you know, they just sort of cop it. That's one more thing. And so, so the only thing that will get rid of that is competition. And so as we saw in that fertilizer market, you get competition through that when you get in commodity markets, competition comes quickly. You know, there's people out there who are more than willing to who have spare capacity, and they'll ramp up that spare capacity and pump it out. Now the question is, are you in economies where you'll see that? Are you in industries where you'll see that passed on? And Australia's problem is we've got a lot of oligopolies in Australia, a lot of very concentrated markets, say, you know, Coles, Woolies, and to a lesser extent Aldi make up, you know, a big chunk of that. We've only got a few banks, we've only got a few energy companies. You know, you go through, you know, one by one and you look at all these different areas, and oligopolies will tend to leave the prices high, as long as they can. So, yeah.
And I chuckle every time I hear people talking about inflation being well anchored, right? The fact is that we've got more and more acclimatized to those higher price rises. You know, you rock up to the local supermarket and you're just used to paying more. So it's almost like, well, you know, because we are happy to pay more and we go on paying more, those large players can exert their market power. And it is very interesting to me that, you know, I'm reading a number of analysts who are saying a lot of these areas where they've still got significant pricing power and market power are where the growth is going to come from over the next few years, because we've got this new environment where everyone just, well, it is what it is.
Yeah. And the question is, so, you know, do we need a recession to sort that out? Yep. And maybe the answer is yes, because in a recession, when volumes start falling, then you start getting, you know, the whatever it is, Coles falls by 5% in terms of their earnings and also volumes, and then they're like, well, maybe we need to cut our prices a bit and see if we can make it up through margins, and make it up through volume. Sorry. Yeah, they start to try and compete for the, you know, there's not as many people buying as many things, and so let's compete to try and get them. And so it's a reasonable one. The other big one is, Yep.
Yeah, I was going to say, so as we move into the last section of the show, another area to look at is the whole question of weight loss medication, because this is again a fast moving sector, isn't it?
Yeah, absolutely. So for anyone who hasn't seen this, so this is a investment theme within our portfolios we've been on for a while, the last year or two at least. With there's Eli Lilly and Novo Nordisk are the two big companies in this, with some quite significant weight loss drugs. Now, I'll give you a quick background. I've got a whole podcast that sort of goes into more details from the other week, and a blog post coming up tomorrow on this. But so obesity, you know, it's sort of third in line of health spend. It's behind, you know, it's behind social burdens, behind smoking and war and terrorism. If you look at the obesity charts, they're quite incredible over a longer period of time. So back in 1975, so this is, I think this is the average within the US. So you're back at 12% of people were obese, and now not now. This line takes us up to 2017 was 36%. I think it's closer to 40 now within the US, and even the obesity rates amongst children is getting quite high, and that's right across all these different countries. So significant. When you look at the health spend for people. The health spend is like on the sickest part of the our population. So you take the sickest, say 5% of people, they spend like 80% of the spend that goes into healthcare. So if you can take a big chunk of the population and make them healthier, then that could have some quite serious implications and flow-on effects. So. It's early days, but I did want to sort of just run through some of the factors. There's one part of it is the stocks, and the stocks for me aren't that expensive still, given the potential growth, and there's some elements that I still like in that. But there's broader sort of macroeconomic implications, I guess, is what I'm interested in sort of exploring, because this could be quite meaningful for everyone. So if you're overweight, there's basically, you can go from, diet and lifestyle is sort of one way you can sort of try to bring yourself back, and that sort of will get you about 5% weight losses, and we won't talk about how much of it comes back afterwards. At the other end of the spectrum, you can do sort of gastric bypasses and quite invasive surgery to sort of knock off 30% of the weight. Now, the interesting ones is mainly this semaglutide, and some of these other ones that are popping up, where what it's showing is sort of 10 to 15% weight loss from these drugs. And the interesting part is it's multifaceted. So one of it is it's increasing how much fat you burn. It's convincing your liver to not put out as much sugar, and one of the key elements, though, is actually reducing the amount of food. So it's actually just it's basically making you not as hungry. So you take the drug, you don't feel as hungry, you don't eat as much, and therefore you don't put on as much weight. So in terms of pros and cons, it's pretty good. So there are some side effects, and these are injectables as well. So they're not sort of at the oral drugs point. So that's one thing that is still being chased up, and they're relatively new drugs, and so there's lots of research being done on them now. But these are natural chemicals that don't really last long. It's sort of slowing down existing pathways. It's not really blocking receptors. And so, it is early stage, but this could be a ground-changing technology, sort of up there with AI in terms of the effect it's going to have, in terms of the amount of impact it can have on society over the next few years. And what do I mean by that? So you've got the drug manufacturers themselves. So Eli Lilly and Novo Nordisk are the two big ones. Novo Nordisk is a relatively pure play obesity. Eli Lilly's got a lot of other things as well, some interesting cancer and other factors, cancer drugs and other factors. But it's most of the upside is from this. But you look at this and you go, well, what does it actually mean for say fast food producers? Is this a negative for the amount of money people are going to spend on food, or restaurants, or your Pepsis and Coca-Colas and things like that? Is there things like ResMed in particular got hit pretty hard, and CSL to a lesser extent, because a lot of the drugs, what effectively Eli Lilly and Novo Nordisk are doing now is going through every sort of thing that where weighing less will help. So the initial thing was this was like a diabetes drug, and then it was like actually it helps you to lose weight as well. And so then you're going through and going, well, sleep apnea, which ResMed sort of deals with. Well, if people lost 10 or 15% of their body weight, for a lot of people that would reduce the symptoms of sleep apnea. They're going through sort of heart disease, high blood pressure. You go through and tick each box, it can make a difference to it. So again, I just want to highlight it's early days, but this could make a huge difference to a whole bunch of sort of, whether it's food, whether it's other healthcare factors. Maybe there's some positive for, I'm still not quite sure. Is it a positive for gyms? Is it a negative for gyms? Are there people who don't go to gyms because they're overweight and embarrassed, or are there more people that will just go, actually, now that if it's a choice between a gym membership or popping a pill once a week, maybe I'll go with the popping a pill once a week. Anyway, there's lots of different flow-on effects. We do have a tilt for people who investing with us passively, that they can put a tilt into the weight loss drugs. They are ones that I'm still happy to own within the portfolio. They're expensive, but I think there's a pretty reasonable growth path that would bring them back to being not expensive, and certainly one I think people should have on their radar of potential sort of game changing themes that could be popping up over the next sort of 5 or 10 years. That along with artificial intelligence.
Yeah, and just quickly on artificial intelligence, because of course the big seven, as we showed, a lot of that's driven by AI. There was a wonderful chart which you're showing now, which I just want to.
Yes.
So here's artificial intelligence in action, right?
Yeah. So rental crisis. This is just one we did for a podcast. Doing one on the rental crisis and the effect on the Australian economy. And so it's this great chart, great picture that that sort of arrived on my desk of all these tents outside the Opera House, and it looks great and exactly what I wanted to show, But then once you actually look a little bit closer, you realize actually that's all wrong. This is on the wrong side of the Opera House. And the bridge isn't over there. The bridge is on the opposite side. And then you start looking at what's behind it and other factors. And anyway, it's well done, but it's but yeah, it's not the real thing.
No, and this is very relevant given, of course, the US elections coming up, and given some of the other things that we're likely to see. So you can't trust your eyes, because this whole idea of regenerative AI, you can basically tell it to build a picture like this with these elements, and it will produce something, right? And it will look photorealistic, and not only a picture, but you can actually make video do the same stuff. So you can never trust your eyes now.
Or your ears. So this, if you're, most people in Australia who's ever called the tax office would be sort of, I guess, familiar with the phrase, in Australia, my voice identifies me, because the Australian tax office has something. It doesn't actually anymore. So your voice no longer, you can upload very quickly. It's called 11 Labs. You can upload, I think it's only about 5 minutes or less of your voice into that, and it will play back. It will then read out whatever you want it to read out in your words, in your voice. A pretty good version instantly, and then they've got another better version, which I think takes maybe a month or something for them to process or do whatever. But it's good. And so from a scamming point of view, I have no doubt that you'll get I'm sure there's lots of people who already get text messages saying, I got one the other day saying, hey, Mum, I've lost my phone. Here's my new phone number. Can you send me some money or whatever it is, And it's going to be a phone call now. So it'll be a phone call to say, hey, whatever. I've managed to download from videos that from Instagram or whatever it is, managed to hook it off. And so here's your daughter calling you, telling you that they're in trouble. They need you to send them whatever money, and here's the bank account details. Yeah. It's going to be, and you ask questions and it'll be able to answer back. So yes, it will be a new world, but and what you say about the US election, I guarantee you there will be a bunch of videos coming out of Biden doing forgetful things and looking like he's senile. Now, possibly some of them might be real, but actually a whole bunch of them are going to be fake. So that's guaranteed. And I'm sure there'll be other videos of Trump, whatever it is, doing illegal things all over the place and leading charges into the. Yeah, I don't know. Whatever you want to, whatever you decide your political opponent you'd like them to do, it will now be completely possible to do that, and quite easy to do. You basically, it's natural language for a lot of these things. Just tell it. I want to show a video of Trump doing this, or I want to show a video of Biden doing whatever. So.
And I guess, more broadly, I always think about what are the implications and consequences of some of these innovations, whether it's the, the weight loss drugs or whether it's the AI or whatever it is, right? There are always consequences and implications. And sometimes I just think that we don't necessarily walk into this with our eyes open.
No, that's right. But I think that's impossible to stop.
Yeah,
that's
I know.
There was a I like to think a disingenuous letter that came out from Elon Musk and a bunch of other people saying we need to, this AI is out of control. We need to pause it for whatever period. But I think it was more from Elon Musk's point of view was like, actually, my own AI is behind. I need everyone else to pause so I can try and catch up for a few months. But
well, in fact, Musk was in the UK. There was a conference that was run by Rishi Sunak, and they had a discussion, and basically Musk said, nobody will need a job. You can have a job if you want one, but you won't need one, thanks to AI.
Yeah.
I mean, it's like, well, okay, interesting world.
Yeah. Well, look, I think there's lots of science fiction writers who have basically come up with that conclusion at some point in humanity, and I guess the question is, when will we reach that? Yeah. I've used a lot of I use the AI for a lot of different things. It's a long way away. I guess for me, I thought driverless cars were pretty close, and actually all the driverless cars guys thought they were pretty close. Probably 2018, 2019, thought they were 6 months to a year away, and they've only really just launched now. It probably took 5 years longer when they thought they were really close.
Yeah.
And that's a pretty, I don't want to say it's a simple task, but it's not that complex of a task. Whereas some of these general AI ones are very good at doing very small things and but the broader conceptual things for a lot of this I think is just going to take a lot longer than that last 1 or 2%. Sounds like it won't take long, but yeah, it will. And so for me, the AI stuff is really useful, where you just need the AI to get it to 80% or 90%. It's great for that. Getting it to 100%, I think, is going to take a long time.
Absolutely. Well, I'm starting to experiment with some of the AI tools around my data, so there'll be some more on that down the track when I'm satisfied that what it's coming up with is sensible and useful rather than actually an hallucination, because that's the problem. Yeah. You can actually end up with hallucinations that sound reasonable, sound logical, and then you actually delve down and think, hang on a moment, that reference doesn't work. So we'll see.
It's a lot better at doing marketing.
Yeah, exactly.
Marketing speak than it is at doing academic.
Exactly.
Stuff.
We'll talk about marketing as we come to the end of the show. What you've highlighted interestingly is in the Nucleus world, what the world funds world, the idea of tilts, right? So you can actually sort of make some sort of adjustments to your portfolio if there's a particular thing that you actually think is worth investing. I think that's a very interesting observation.
Yeah. So both, you can either screen stuff out you don't like or add stuff in you do like. So nuclear power is a great example. There's people who sit on one side of the fence, people sit on the other. So, and for us, it's like about saying, we've got our own portfolios we'll run, but if you don't want any nuclear power in that, you can tell us never invest in that. Or if you say, no, I want nuclear power, give me some extra, you pick a tilt. And we added a few extra ones in the last month. So we added the obesity drugs one, just because that was, sort of topical. And the other one is three different flavors of gold. We already had the gold stocks there, but just given the way people are like to invest in gold, and they wanted to sort of a tilt to either the physical gold or the physical gold hedge back to Aussie dollars. So keeping in mind that we're investing in while I say it's physical gold, it's an exposure to the gold price directly as opposed to an exposure to gold stocks. And so, and that is through an ETF. So no, we won't be sending you gold bars, but but yeah, it's an extra way to get exposure for people who feel as if that's something they'd like to see more of in their portfolio.
Yeah, and it goes back to this agility and flexibility and transparency, which of course is the mantra that we keep coming back to. Damien, I want to say thank you very much. A very interesting conversation. We covered a lot of ground and a lot of interesting concepts and ideas. And I'll look forward to picking up with you again over the next month or two, over the end of the year and beyond. Always interesting time. And I think the markets are going to be wobbling around for quite some time over the next little while. So, hang on there and see what happens, eh?
Absolutely. I'm sure there'll be something interesting to talk about next month.
Look forward to that. Thank you very much. I'm going to take you offline and I'm going to close the show. See you later, Damien. Thanks.
See you.
So there you go, folks. I hope you enjoyed that. Good conversation, I think, and lots of interesting concepts and ideas. Just to say that next week it's going to be me. I'll be on and I'll be talking about the latest financial stress and modelling, and specifically some of the work I've been doing with regards to how AI plays into what I've been modelling. So it'll be interesting to explore that. Make a note in your diary, and of course I'll be putting the pre-recorded shows out for the rest of the week. In terms of doggies, we have one doggy. Luna's in the basket. Meteor's somewhere around. I think she's wanting lunch. So that's just the way that is. But there's Meteor. There's Luna there, still asleep. So that's pretty good. Thank you very much for spending some time with us this evening. Thank you, Jason, for the super chat and the other comments and the conversation from everybody else as well. Really appreciate it. And I'll look forward to seeing you same time next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.